Silicon Valley Bank became the largest bank to fail since the 2008 financial crisis in recent weeks. Now, the sudden collapse rocked the banking sector, creating ripple effects in global markets and leading investors to draw numerous comparisons between SVB and the global financial crisis. Though some experts note that Silicon Valley Bank's collapse is more company-specific. For more on what distinguishes the two events, as well as the outlook for taxpayers who could be expected to foot the bill for SVB's unsold assets, let's get to New York Times business investigations editor David Enrich. David, thank you for joining me this morning. So, of course, we're used to seeing these comparisons now at this point between what we saw with the 2008 financial crisis. What are some of the more distinguishing features when it comes to SVB and Signature Bank's failures?
Well, as people have mentioned ad nauseum at this point, these were specific to interest rate risks, and both banks being woefully unprepared for something that I think many people saw coming a mile away, which was that rising interest rates were going to diminish the value of some of the bank's assets. And to me, this is something that is, scary in the moment. There is some fear that this is going to spread to other banks, but this is a far, far cry from what we were seeing in 2007, 2008, early 2009. And these are problems at relatively small banks in the grand scheme of things. And there's not been any signs, at least in the US, that the major banks, the ones that are really key to the stability of the financial system, are suffering any sort of run the way SVB and Signature were.
And to speak to that uniqueness, 94% of SVB's deposits were uninsured, as were 90% of deposits at Signature. Yep. Certainly not the norm by any stretch of the imagination. How much of this, though, is the psychological aspect of it? How much is that still lingering? We are seeing still regional and big banks at least rallying today.
Yeah, well, we've seen this kind of go back and forth over the past couple weeks. There'll be a day of relief, then there'll be a day where things get a little more pessimistic, bordering on panic. And as you said, the problems that made Silicon Valley Bank and Signature Bank so susceptible to these sudden shifts in confidence, or the fact that they had so many uninsured deposits, their liquidity position therefore was really, it was not, the deposits were not sticky, to use industry parlance. And they were on the far extremes of the banking industry overall. There are a lot of banks, though, that have what I think many people would consider to be an over-reliance on deposits that are going to be more susceptible to just rushing out the door at the first hint of panic. But at the end of the day, banks are, their fortunes hinge on the public having confidence in them. And I think that this is one of the crucial differences between now and 15 years ago, is that there's been so many efforts to stabilize the banking industry and fortify it and make sure that, their capital and liquidity positions are much stronger. But I think it's going to be the odds of serious crises of confidence toppling major banks are a lot lower than they were 15 years ago. That's not to say they're zero, but they are a lot lower, I think.
And we obviously have the Senate bank hearings coming up this week. Questions about what regulators could have perhaps done. Did they drop the ball? And if some of the existing guardrails and protections under Dodd-Frank could have prevented these collapses. But what are you going to be watching for here?
Well, this just reflects my bias as a journalist, but I love the backstory of these things. So I'm going to be curious to hear just any of the narrative detail. I don't think that's what investors are going to be looking for. But I think there's going to be some real questions of accountability, not just for the people at these banks, although they definitely deserve it, but also the regulators that clearly, especially I think in the case of Silicon Valley Bank, appear to have been kind of asleep at the switch. And there were the issues that brought that bank down. I think for most industry experts and people who are closely following the economy and the financial system should not have been surprises. And yet you had regulators at both the Fed and in the state regulator in California not really ringing the alarm bells, at least not nearly as loudly enough as they apparently should have, at least in hindsight.
And I know something else people might be watching for, wondering whether or not the taxpayer might be on the hook for this roughly $90 billion in SVB's securities and other assets that weren't included by that sale to First Citizens. Now, we know that President Biden, when it came to the initial rescue of the banks, was saying, look, this isn't something that will fall on taxpayers' shoulders. But what about this remaining $90 billion? Can he make that same guarantee?
I don't know if you can make that guarantee. I do think that there are look, I mean, there's a bunch of the balance sheet that needs to be unwound gradually, and obviously a lot of the securities on the balance sheet have lost a substantial amount of value. The longer you hold it, the greater the odds are that maybe the assets regain some of their value. And look, but a lot of the losses that the FDIC risks being exposed to, both with the remaining stuff on the balance sheet and in part because of they struck these kind of asset price guarantees with the buyers of both with Signature and Silicon Valley Bank. A lot of those losses, if they are borne out, will be borne not by taxpayers, but by the FDIC Deposit Insurance Fund, which is not being paid for by, you and me. It's being paid for by fees that are imposed on banks based on the riskiness and size of their deposit bases. So I don't think this is likely to be a huge taxpayer bailout, if to the extent that it affects taxpayers at all. And I think there is definitely some risk that taxpayers will be on the hook for a bit of it, but these are not huge numbers. And again, at least not compared to the bailouts we've seen back in 2008, and even in the more recently, and with the pandemic era bailouts of big industries like the airlines.
If anything, might be perhaps more expensive as the lending conditions get a bit tighter. Might see some of those costs passed on there. Yeah. I do want to just quickly ask you about Deutsche Bank. I know that you've followed their rise and the scandals attached to them, because their name came up as the potential next shoe to drop in light of Credit Suisse's fallout. Yeah. But what is your thoughts on that in terms of, would Deutsche Bank be too big to fail, and is these concerns about Deutsche Bank being next, would they be overblown?
Well, Deutsche Bank is definitely too big to fail. There is not a chance in hell that the German government or probably the ECB would let a bank of Deutsche Bank's size and kind of prestige go down. I'm not sure how well-founded these fears are, to be honest. And I think Deutsche Bank, look, it's a problem child and has been a problem child for a very long time now. And I think it's a natural place when investors go looking for the next bank to go down after Credit Suisse. Deutsche Bank is just probably going to be on the tip of everyone's tongue. It certainly was on the tip of my tongue when people started asking me what might go down next. And that's I think in part a reflection of its legacy, its history of really terrible problems. The bank is on much stabler footing than it was 5 or 10 years ago, for sure. That being said, it is still a giant bank with a lot of legacy problems on its balance sheet. And I think that makes it vulnerable in times when there's a crisis of confidence. But again, I think this is more than anything a reflection of the fact that if you ask anyone who's been paying attention to European banks over the past 5, 10, 15 years, the worst bank on the continent, historically, that has been Deutsche Bank. And so I think it's a normal, natural, kind of automatic place for people to look for the next sign of trouble.
But as you mentioned, they're not quite as poorly positioned as Credit Suisse, with its own headaches and scandals as well. New York Times business investigations editor David Enrich, thank you so much for joining me.